Hello guys, and welcome to another episode of An Alien's Journey. Today we're going to be talking about how to start investing in the stock market, where to begin, start your account, and where to place your money in order to make even more money. Let's dive into it. Probably since I graduated from high school, I was very interested in the stock market to understand how it works and how can I make money from that. I read a lot of books, I read a lot of articles about it, and what I found out is that most of them are recommending a pretty simple and basic strategy in order to have over average results and returns on your money. And we're gonna see some studies and some shocking statistics about it. First thing you need to do after you save some money and you want those money to make some more money for you is to open a brokerage account. Since you can't go out there and just buy and sell stocks like you go to the market, you have to open an account with a brokerage firm, and this firm is gonna place orders at your behalf. And after you have your account set up, you can start investing in the stock market from your laptop or your smartphone. There are many companies that are offering this kind of services for low cost or no cost at all. I have an account with Charles Schwab since they were the very first brick and mortar company in US that waive all the transaction fee, and they don't have any fee for any buying and selling of stocks. That's why I open with them, but there are many other companies very good here, so you have a wide variety where to choose your brokerage account. And depending where you live, you're gonna find a lot of brokerage firms that are gonna give you exposure for the whole stock market nationally and internationally. Now that you got your brokerage account set up, you can start buying and selling shares from any companies as long as it's a public traded company. But there are so many public traded companies out there and you don't know where to put your money in order to have the best return on your investment, right? I would say the best, safest and easiest strategy to invest long term for an average person is to invest in index funds. And it requires very little work, no skills needed, and it still has some of the best returns out there. And this strategy outperforms 99% of the individual investors and 95% of the actively traded hedge funds. So if you think you're not in that 1% category of people very knowledgeable that can consistently beat the market, you should probably consider investing in an index fund. So what exactly is an index fund? When you're buying a stock, you're buying a small percentage of a company. Let's say if you buy the shares of Amazon, you're gonna own a very small percentage of Amazon. But when you think about an index fund, think about a basket with like 500 different companies. And when you buy the index fund, you buy a small percentage of every single company inside that basket. Probably the most popular index fund is the Standard & Poor's 500 or S&P 500 in US. And if you put your money in this index fund, you're gonna own a small fraction of all the top 500 companies in US. But there are many index funds out there for any market and all kinds of investments. You can buy an index fund that has exposure to the entire US stock market like VT Sachs, or an index fund that has exposure on the entire bonds market or real estate and so on. Or if you want to invest in European stock market, you can invest in FTS Euro First 300, which follows the performance of the top 300 companies in Europe, or a Vanguard index fund that is giving you exposure to the entire international stock market. One of the biggest advantages in investing in index fund is that you have very low annual fee. And the reason for that is because it's very easy to put together an index fund, it's very easy to manage, it's not much overhead, and all the profits are going to be passed to you, the investor. And this is known as a passively managed fund. You're building an entire portfolio that gets adjusted and balanced over time without doing any work, and you only pay for that between 0.03 to 0.04% annual fee. And this is the opposite of what is called a mutual fund or a hedge fund. This employs professional stock pickers in order to buy and sell stocks in order to beat the average market return. However, all these professional stock traders who are paid millions of dollars a year and all the transactions fees from all those buying and selling of stocks are passed finally to the investor, and this translates in higher annual fee, which is averagely between 0.5 and 1% and sometimes gets up to over 2.5%. This is 12 times to up to 65 times more expensive than an index fund. And all of this comes with the risk that you don't know if you're gonna even beat the market in the first place. And when you're looking at statistics, in 92% of the cases, the S&P 500 index fund outperformed the large cap actively managed mutual funds. and the mid-cap actively traded mutual fund was outperformed 95% of the time by the index fund. So the chances to beat the market investing in a mutual fund, it's 1 in 20. Warren Buffett, one of the most wealthiest person living on earth right now, recommended investing in index funds as being the best strategy for the long-term average investor. And this year, May 2nd, in the annual meeting of his company, he said once again, quote, "In my view, for most people, the best thing to do is to own the S&P 500 index fund." So I guess if one of the wealthiest person on earth is recommending you to buy an index fund, you should probably do that. In 2007, he made a $1 million bet that an S&P 500 index fund will outperform a basket of hedge funds in course of a decade. And as you expect, after 10 years, he won the bet. The index fund had a 7.1 annually return, easily beating the 2.2 average return for the hedge funds. And you have to keep in mind that the people that are managing these hedge funds are the best in the field with the best education. They are doing this every single day. They are trading stocks full time. This is their jobs. When it comes to individual stock pickers, the percentage is even smaller. Only 1% of the active traders are consistently beating the market. This means 99% of the time they fail to do so. And this is because most of the people are trading emotionally. They panic when the market goes down and they sell in order to cut the loss. And after that, when the market goes up, they go and buy aggressively in order to don't miss the opportunity. And like that, trying to time the market, they are buying when the price is high and they are selling when the price is low. And because of that, this correlates to much lower than average returns. In an interview in 2017, Warren Buffett said that trying to time the market, it's a mistake for 99% of the people. Another advantage of index fund is that you have huge diversification. Even if you have a diversified portfolio with like 20 stocks and if one of it goes down and fail, you're still gonna have huge losses. On the other hand, if you invest in an S&P 500 index fund, you have 500 strong companies you can rely your return on. And if one of it fails, you have 499 other companies to boost you up. And like that, you're pretty much not gonna see that loss. Another big advantage of the index funds is that it's very easy to invest in. I'm not a stock market expert. I don't have the knowledge and nor the willing to spend hours and hours reading the financial sheets and analyzing trading charts to be able to predict trends and like that to know where to put my money. And even if I do have the time, if 95% of the hedge funds managers who are the most skilled person in this field can't beat the market over the long term, what makes me think I can? And this is so much less stress going with it. It's just buy and hold. There is no wake up in the middle of the night worrying about the earnings report tomorrow. And this was my strategy so far, just buy and hold index funds and don't worry about the short-term market fluctuation. Just be consistent at doing it. Set up an amount of money that you're going to invest every single month or every single year or every single quarter, whatever period of time you choose, and keep buying it constantly without worrying about the market that is high or the market is low, because during the long term you're going to be averaging the market and you're going to be fine. This is known as dollar cost averaging, and keep in mind that time in the market all the time beat timing the market. If you want to know more about the stock market and the investing instruments, I totally recommend you the book The Intelligent Investor by Benjamin Graham. It's a great book, maybe one of the best classic book about stock market investing. If you're going to read that book, you're going to have very solid foundation for your investment strategies. I hope you know better now how to invest your money in the stock market. It's really that easy. It's requiring only like 20 minutes of your time. Just go out there, set up the brokerage account, put your money in and buy that index fund and just hold. It's nothing else to do. Alright guys, thank you very much for watching. Please subscribe to this channel. If you like this content, give it a like. Let me know down in the comment what do you think and what is your approach of investing. And see you next time. Thank you. Bye.